Okay, so let's get it started then. Thanks a lot, everyone, for logging in today. I want to thank you for taking the time to come and watch the webinar, and also want to thank, of course, FX Suite for offering me the opportunity to provide this content to you today. So what I'll do, I'll close the chat and the attendee list here. I'm not ignoring you. I've just take it out of the way, and you can keep writing your questions, and I'll answer all the questions at the end of the webinar. There's quite a lot to cover, so I'd like to start right away. So I'm Giuseppe Basile. I'm also known as the Fib Stalker. That's quite an aggressive name, but we are all in this market, in this market, which is a very competitive business. So they might well be appropriate. But I promise you, I'm a Fib Stalker. I'm a stalker only in the market. So so again, thank you. And for those who don't know me, I want to say that I'm a computer science engineer with a recent master's in finance, and I am also a CMT. Certified CMT, and I am associated with IFTA, which is the International Federation of Tech Analysts. I started trading in 2001, 2004 committed to research, 2006 understood that I needed mentors, and I started working with successful traders and mentors around the United States and Europe, Ivica Jurasic, Van Tarp, Dear Barton, David Asley, just to name a few of them. And in 2009, I got interested in algorithmic trading, and I started studying the effects of program trading on price, and collected 7,000 hours of screen time on top of already more than 10,000 hours that I collected before. So in 2012, I started the Fib Stalker. I provide signals and comments on futures, forex, and stocks, and I also actually do a lot of research. And today I'm going to show you some of the results and some of the consideration on the traditional use of Fibonacci, and also show you how I use Fibonacci to with a different flavor to actually frame participation of program trading in the market, and also price discovery. So that's what I'm going to talk to you about. Before I continue, a little bit about risk. Risk is very important. Always mind your risk. I have an acronym, PPC, Protect Precious Capital. This is the rule number 1 of the game. And you know that when the money is gone, the game is over. Still, we know that 22% of traders do not use stop losses. As a result, they get the margin call. So don't be one of them. We also know that in the Western countries, between 2000, so new traders lose between 2,000 and 6,000 in 3 to 6 months. So only 2 to 5% of traders make it consistently. So you have to be in that group. And so I'm adamant about risk management. I'm also a fan of doing things differently. So you should ask yourself very often, how am I doing things differently in order to be a winner, rather than become statistic and become one of these 95% of traders who lose money. So if you're watching this webinar now, the recording, just stop it now and have a look at the disclaimer here. So today I'm going to talk you to talk about traditional ways of using Fibonacci, and also the problems attached to this, and specifically the lack of reliability and the lack of timing techniques that come with traditional use of Fibonacci. There is an opportunity to use Fibonacci in a different way, as I'm going to show you, and those who know my work a little bit know the way I use Fibonacci, and this way is grounded into the existence of program trading and algorithmic trading in modern markets. And I'll also show you one of the way of framing the effect of program trading on price, and that's very, very interesting because it gives us a new perspective, fresh perspective on the market. So that's what I hope, at least. I'm going to introduce here Fibonacci numbers, but I will give these for granted. I want to do, particularly, I want to do some consideration on them. So they were introduced or discovered by Leonardo Pisano, and we all know how they are calculated. Each number is the sum of the two previous numbers. So I'm not going to, go in detail into this. There are some ratios that now that state that one manifestation in nature divided by the subsequent or the previous one gives us this special number. Actually, as we calculate these ratios, the number gets closer and closer to 0.618 and the 1.618. So this is the golden ratio. There are other numbers that are a little bit fishy. I mean, I believe there is a little bit of engineering there in order to derive this number. So for me, they have less importance. So I call them uninvited guests. And for example, the square root. Now, the square root, it's a calculation, and the nature speaks about ratios, does not speak about square roots. So this number, 78.6, 127, also 50%. Now, 50% is a very important number. It's not a Fibonacci number, but it comes from, the halfway back, the ambush trade, very, very much used by floor traders in the 70s and 80s. And it is still an important number. Other numbers, really don't make sense to me. So I'm not going to spend a lot of time on this. I'll just say that I keep only a very small group of numbers here, 50%, 61.8%. Instead of 127, I use 123.6%. I'll explain you why. And then I keep 161.8%. But for the purpose of the exercise, let's keep all the numbers. And remember, the 78.6 sometimes is indicated as 76.4%, 2 times 38.2%. And, there are a number of ways to derive these numbers, and there are a number of ways to actually justify these numbers. But that's not what we are going to do, actually. Now, how common retracements are used? They're said to be very powerful in trading, and of course, because they actually model one of the truths in the market, which is that the market moves in trends. And but this retracement very often have to be cannot be traded in isolation, but have to be traded with other signals, like for example, candlestick indicators or candlestick formations. For longs, this could be bullish engulfing or Morningstar. I don't use candlesticks. I use put prices. I'll show you later on. But that's the way traditionally sorry, just let me check if everything is fine. So you can hear me and everything is fine. Okay. So what I was saying is that then this common retracement can be used on different time frames, and typically, the time frame can go from 5 minutes to a weekly. The way they're used, the problem with Fibonacci is that we never know where they stop. And sometimes they stop at 50%, sometimes at 61.8%, and sometimes they just overshoot the fib level, and we don't know how to time it, how to trade it. And some people believe that 61.8% and 76.4% are very powerful levels where the market can retrace and actually reverse. So again, the very difficult part is to know which level will actually hold. There's also this concept of convergence, whereas multiple levels coming from different traces, when they cluster together, converge together, make that level more significant. We will see that. I really don't accept and trust that kind of concept. I'm gonna explain why. So a little example here. Very, very intuitive. What I want to show you is, when we trace from A to B, there is the market that continues there, and eventually at this 23.6, or if you wish 76.4, there is the actual signal. But you have to note here that there are multiple levels where you would actually get you would actually get some false signals here. And now I cannot say very well because it's a little bit slow, but basically you would have here a signal, you would have a signal here, and then eventually a signal there to enter short after the point C. So what I mean here is that this example shows clearly that we have to know how to manage multiple failures before we get the right level. So before we actually get the right signal. So and so it means that we have to have very strong money management in place, and it's very difficult to trade these signals like that. Another example is a buy, but I'll not spend a lot of time on it. Again, here we would have a situation whereas right at this point we would have a false signal, and then eventually the market will continue lower. So in this case, in C, we also have morning star, but it's not that the market is giving us a morning star or a precise entry every time. So that's just fantasy. That's just this specific example. So again, I mean, a very strong, very good and strong money management must replace this lack of reliability that we have when we try to use Fibonacci this way. So let me just continue then, and in Fibonacci, the ratio of Fibonacci, we also find the concept of extension, expansion, and projections, and there are some beliefs around this. These values are calculated, but I'm not sure they're really very grounded into market behavior. I always look at designing my strategy around real market behavior, and I'll show you what I mean later on. So some people believe that retracement into 61.8% should go at least into the 161.8 projections. There are also other levels, 100, 200, and 261.8%, but I showed you before that I don't really trust a lot these levels. There are some levels that are also mentioned by other authors and traders, like the Napoli level, so the OP, COP, XOP, and the XOP actually corresponds to the 161.8%. There are other patterns that are believed to be very strong, like the A, B, C, C, D, or 1, 2, 3, 4 pattern, but actually they suffer from the same problem because we need to always we need always to time the C here. So again, in this example, we have multiple examples of failure. And again, let me show you what I mean here. For example, this level here is a failure, and this level here could be considered a failure. So we have the same problems here. There is another important point is that actually moves above the level 61.8%, in my experience, can be explained in a more effective way when we explain price through the effect of program trading. So some also Morningstar in this case are not very, very common, as I said before. So the supporting signals are not very common. So there is this other concept of confluence and convergence, and Di Napoli calls this K2, K3 confluences. The main idea is, when I trace from different levels, and then I look at the areas where the levels, the Fibonacci levels cluster. But the problem is that I believe there are three main problems with this concept of confluence and convergence. And first of all, I mean, if the single levels are not reliable, how true levels can be more reliable than the single level? So this concept really does not hold logically. And typically also, these trades are made from levels that are totally, to me, they are totally arbitrary. For example, in this case, I trace from here to here, and to me, this level does not really make a lot of sense. So I'll explain you later on. And the third point is clustering. So clustering means that levels have to be they have to show in a title range. Now, what is a title? How much is tight, right? So again, we have indetermination here. So this is not the way I trade. My trade is very deterministic and precise, and I'll show you later on. And these are the main problems of convergence as well. And this is very funny to me. One more point I want to show you here. This is very important. And here, very often, those who use Fibonacci actually change. So just a moment here. I just want to make sure that I can see the chart, because when I try to annotate, I don't see the full chart. So here we have A to B. So we trace from A to B. And of course, all the levels we get are levels where we want to see a retrace for a short. But here, see, we invert the semantic of clustering. And this is very often semantic of actually retracement, because we trace from A, B, so we are looking for a level too short, but then we actually invert the semantic, and when we trace from C to D, we are looking for a long. So we use one level that we trace for a short, and we combine it with a level that we use for a long. So it's very confusing, and of course here, the entry also in this specific example comes after a double bottom, which is a very very arbitrary also formation, and there has to be a way to actually express this in a more formal way. So these are some of the problems we have then with Fibonacci, and I already talked about them, so I'll go very quickly on them. Is there really value in convergence? They must be traded in conjunction with other signals, which introduces the need of reconciliation. And every time you have to reconcile more than one thing with price, you will always get situations where it's difficult to reconcile because you're getting different signals. So there are no entry and stops if we use Fibonacci by itself without any other signals. Market structure is not taken into account because we don't know what happens after we see a swing high and low. We don't know which kind of participation. So we need to have a way to measure that kind of participation. There are ways to explain 161.8 in a more strong and effective way. And, some of the ways are really arbitrary. Some of the ways we use Fibonacci retracement. So apparently then there is some value there, but we need to see where it's located. So, but before we get there, let me try to give you another perspective on modern markets. And if you you have not heard this somewhere else, I mean, I'm giving you a little perspective here. The reality is that in modern markets, more than 80% of volume is traded by computerized algorithms. And that's especially true with futures markets. When it comes to option, 20% was the estimate in 2010 to be much higher. Forex is 25% in 2006, believed to be 45% in 2010. So in 2014, could be 50% or higher. Then there is high frequency trading, which is a very known phenomenon, with an estimate of 35% to 75% on European and American equity markets. And finally, program trading, which is an important class of algorithmic trading, and the class I focus on, which is known to be responsible between 20 and 30% of the overall volume. If I gather this information from the source you see here, so the question I have then, based on this, are we sure that we can keep using traditional methods and still be effective? Of course, my answer is no. So there are only a few things that are true about markets and modern markets. And one of these is definitely the existence of trends that we have to keep leveraging upon and using. And I'm not going to explain what a trend is. Of course, you know that. The nice thing and important thing is that now trend can be proven formally. So they are there. So not only we can see them, we can spot them, but it has been proven formally that mathematically that they exist, as well as it's proven the existence of algorithmic trading and high frequency trading. So what I'm going to do now, I'll use the numbers that I've provided you before, just the selection that I use, and actually the 50% is going to be my entry of start of support or resistance. 61.8% is the stop loss or the end of an area of support of resistance. The first target is going to be my 123.6%, and the second target was 161.8%. So I only use these numbers. This is the way I use them. So and on my charts, the targets show up as minus 23.6% and minus 61.8%. So by using this number, then we can actually find ways to spot effects on price from program trading. And the way we do this is by measuring and by framing price structure, and algos. When algos participate, very often they will participate at the 50% retracement. In this case, the point C in this chart, in the chart that you see on the left side here. And we'll do whatever it takes to bring price into the first target, the minus 23.6% Fibonacci level, which is represented by D in this picture. And there is also the opportunity to for price to go higher into the 168.8%, the minus 61.8% here in my chart, which is the point E. So all these levels are deterministic. There is no guessing. And program trading on the markets with large volume is active on all time frames, and including take 1 minute, 15 minutes, 4 hours, daily, weekly. And if you review my work, you'll see that I use these levels all the time, and these levels also allow for price discoveries. I'm going to show you in a minute. What happens then when market reach the second target? There is also an opportunity for this market to change gear, and actually it means that now the next measure move in the Fibonacci sequence will actually be traced from highs to highs. In this example, from D to H. And the targets will stay the same. So the retracement will be in I, and the target will be L and M here. So I think this is a behavior of the market. It's often missed by traders, and they try to explain this. Retracement here, these shallow retracements with Fibonacci retracement 32.8%, 33.6%, but that's not the case. There's a better way to explain price structure, and of course, you might think, well, but this is just theory, right? Show us these trades, and that's what I'm going to do very quickly on the weekly time frame of the euro here. And just very quickly, I want to show just an example and then continue, because I will show you a complete example in the end. But when we look at 2011 highs, we had a trace here, and market got into this area of resistance starting from the 50% level, 140.44. I was never able to break the stop at above 142.56. So the price went down and went into the first target, money 23.60, as you can see here. And then we could trace the next measure move in the sequence from highs to lows. And as you can see here, the market actually went again into the second the first target here, and then the next measure move failed here. But as you can see, there were two very good setups here. So I'm not going to explain now the meaning of this failure. I'm going to go back to the presentation, and then if you have any questions on that, you can provide the you can write it and I'll answer that later on. So this is a very simple example. I could show hundreds of examples. If you go to my website www.fibstalker.com, you will find plenty of them with trading plans that I provide in advance. So how can we use then the presence of algorithmic trading on price? If you believe that price actually is program trading is active on price on all time frames, I'll make an example later on, then let's consider this move A to B and a retracement into a level of support, or a level that is that should provide support. However, you identify this level. What happens is that in the retracement between B and C, there is again a sequence of measure move, like very likewise we saw in the euro dollar before. And what happens is that the market follows the measure move, and after it tests support, there can be two cases: whether the market continues to respects the measure move here, so it continues lower. In which case, can you see, we don't risk anything. I mean, we are considering this as an area of support and just testing that area of support. If the sequence of measurement continues lower, there's no action here. We don't risk any money. We know that this area is not actually providing support. But what happens if the market breaks above the stop level of the next measurement in the sequence? Well, that's a confirmation that this area of support actually strong enough to break the sequence of measure move lower. So this is a very simple concept, but very powerful, because it allows you to procedurally basically test level of support and resistance. I call this fib stalking, and that's one of the techniques that I teach. And it's very straightforward, and it trusts the fact that there is program trading on all time frames. So let me show you again an example of this. This is not just theory. I use this every day in my trading, and I want to show an example, a very recent example on the US dollar versus Japanese yen. Let me remove here. Last week, I provided an area of resistance with 4 days in advance here, and it was this 102.23. So when we go and study the sequence of measure move higher from this level to the area of resistance, so I made this trace and I say, this is for me a potential area of resistance. So how do we procedurally test that this is an area of resistance? So that's quite straightforward. And let me show you why. You can remove all the stress from the trading process, because now see this area here is the area of resistance, and we have it here. And you could actually very simply study the sequence of measure move higher. So starting from this level, we had a first trace. There was participation at this level, which was able to bring price into first target and second target. So when we apply our rules, the second target was it. So we trace an extension here. And as we can see here, very interestingly, the market initially participated at this level, but then it broke this level. And that was our entry point for this market with a stop above highs. And this, as you can see, this makes the study of this move higher and the violation of the sequence of measure move allows you to enter this market without stress. And that's, the main contribution, the main idea of the fib stalking technique. So I hope this gives you an idea of how powerful this method can can work. My accent, I'm Italian, so I know it's a little bit strange. Anyway, let me continue on that. I hope it's understandable. If you have any other questions, I can try to answer them, or doubts, I can answer them later on. Okay, so I showed you an application of the Fib stalking technique. Now, let's look at final comparison between Fibonacci and the Fib stalker method. So, again, I've prepared an example this time on the New Zealand dollar versus US dollar, and what you see on the screen is the weekly time frame. Now, on this weekly time frame, we have a long-term support at 0.77, and I've been talking about this support for months, if not years here, because this value they hold on a very long time frame. So we have support at 0.7710. And there were people around this level that they were actually bearish, and I say there's no need to be and no reason to be bearish because we had support here. So let me show you this very good trade I've been following, and when we trace from lows to highs, we had this 81.10 level. It acted as support 3 times, and eventually the market never broke below this 0.80 or 9 here, and the market actually continued higher right into that first target. Look at how powerful are these targets. And that's the reason why you have to use minus 23.6% and not 127%, which is derived using square roots. So, but most importantly, this level now, if this level was broken, 0.80, 0.9, we would have probably seen a move, continue to move lower into this 0.77. So this is the first idea of using this level for price discovery. If this level is broken down, is pierced on the downside, then we have a potential for a continuation lower. Otherwise, if this area of support holds, we look for a continuation higher. Now, let me show you when we move into the daily charts. I already prepared here some traces for you using the standard Fib level. What I did, I traced it from A to B, and these are all the different traditional levels we can get. And as you can see here at the minus 61.8% or 161.8% C, we get a reversal. So you could say, oh, I'm good. If you enter at this level 0.8347, you could say, well, I could use effectively the Fibonacci retracement because then I exit at 168. That's true, and that's possible, but let me give you another perspective here. Let me remove this and show you that when we get into this area of support now, we know that we have a powerful technique, which is the Fib stalking technique to time whether this market is continuing lower or moving higher. And how do we do that? Very simply, using the same technique I've showed you before. And so let me zoom this a little bit. So we trace, instead of tracing the full Fibonacci numbers, we trace from H to B. And as you can see, we have participation here. The 0.8346 is never breached on the upside. The high is 0.8345. And that's very common. And we get into the first and second target. When we get into the second target, we know that we're moving in extensions, and so what we do, we trace from B to C, and now something nice happens here. First of all, the first thing we notice is that price gets into the second area of resistance at the beginning of it, 81.37. And initially there's a reaction lower, but then eventually it breaks this level. So what we see here is that first of all, we have again a confirmation of this area of support, because price now broke above this level. And that was also our entry point with a stop below lows. And again, we have this level gives us very important information about price discovery, because now we know that we actually know that this area of support has held. And if this area of support has held, then the market has the potential to go to this first target. And again, this is the power of price discovery that these techniques or any techniques that studies the effects of program trading will give you. And it gives you also a fresh and additional perspective on whatever method you use. You add up these kind of considerations and actually will help you with your trading. So the other example I wanted to show, and I'm going to conclude here. I think I'm 5 minutes beyond the time, but I hope this information is useful. So I'll just finish and show you the other example here. So let's say that somehow you were able to time the C. What you do then at some point, you trace using the Fibonacci levels from C to D, and you'll have a retracement here as usual. The retrace is overshoots this 38.20%. But let's say that you would enter here and then activate the 100. As you can see, the 100 somehow is very close to that first level from the wider trace here. But let's see at the sequence of measure and move here. First of all, when we look at this move higher, we know that we are already moving in extension. So that's what we will do. We'll trace from highs to highs, and we capture the first area here. And again, we can use, I'm not going to show you this, but we can use the fib sorting technique to model what happens in price when price gets into this area of support. When price goes to first and second target, let's see that we exit the first target, but then price continue high. What do you do? I mean, we are in extension, so obviously what we do, we trace from highs to highs, and we have another level of participation here. Price never gets below 084.85, and we get to the first target, to the pip. Price then retraces, and again, keep following our rules. And of course, I didn't give all the rules, but that's the way we keep trading. And again, there is participation at this level. The market cannot make it to the first target, but it makes it to the first target of the largest time frame. Remember that we have this trace here, and this 87.44 is the first target of that trace. So program trading is coming in and taking profits right here. And that's the reason why we saw this market moving lower. But the market gets into this area of support again, and eventually it's able to make make it to the first target there. And what happens after that? We are seeing on the smaller time frame, we are seeing now measured move lower, as you can see here. The market is participating at this level. So I hope this gives you a perspective on the way Fibonacci can be used to actually trade the markets. And I have a table here with some of the differences. There's not a lot of time to go through it. I will leave it for a few seconds, so those who watch the webinar can actually go through this. And after that, that's everything I wanted to say. I hope this was interesting, and I'm actually going to look at your questions now and answer your questions. So the first question from Forex Gal, what does 23.6% represents? Actually, it's not a formal Fibonacci level. It's a little bit like the 50%. It works very well, and it's a high probability first target. So my recommendation is that is that you keep observing it, and you realize that that actually is very, very powerful, very, very high reliability and high probability target. What time chart do you prefer? Well, program trading is actually in all time frames. As I showed you, we could go down to the 5 minutes, the 1 minute, even the tick chart, and you will see all your large volume markets, program trading, very, very active also on those. So the way I look at the market, I look at the daily and the weekly. I drill down into the 4-hour charts, and you can actually trade the 4-hour chart as well using the same methodology. And then, as you could see, we could also time the market on the 15 minutes. So my preference is I'm a swing trader, so I stay on the daily and 4-hour charts. I'm trying to work out your accent. Thank you. Do you draw a fib for each time frame, or do you keep the same fib when changing time frames? No, as I said before, program trading is active on all time frames, and you can frame the sequence of a measured move on each time frame. So it's important you actually study the sequence on all time frames. So very interesting method. I have to look into it further. Yes, if you want to do that, go to my blog as well, and you can subscribe to my free newsletter. And I'm going to provide weekly reviews, and also on the blog you'll find very often daily reviews with trading plans and an analysis done well in advance, so you can prepare sometimes days, hours, and days before the actual setup takes place. And by using the fib stalking technique, you can actually time the market. Strong support 23. It's not clear to me the question. It's not supporting the example I've showed you before. There was a profit-taking level. If you mean this level here, this is a level of profit taking, so it's not support. Okay, so if there are other questions, I'll be happy to answer. Just I want to have questions for all of you. Was what I presented today understandable and actually interesting? Another question here: the educational session for your blog is still in work? Yes, I mean I actually keep adding content. Actually, there is a lot of content in my blog already. I just have to find the time to organize it, and I'm organizing it as time goes. If you search in the blog, you'll find a lot of articles that are actually they explain some of these concepts. How do you decide your A, B, C, D? Well, I did not decide it. I've researched Fibonacci quite a lot in the past. A, B, D, C. ABCD is actually a very common pattern now in my presentation. When it comes to the example I had before, let me go back a little bit here. I think it was this one. So, well, here when the market start correcting here from this point, you can keep. So as the market goes high, you can keep tracing your Fibonacci. Then when the market start coming back, you keep that trace, and in this case they say that 76.4% retracement is very common. I don't believe that. I don't know. Do you know Ichimoku? No, I don't, and I believe that when you get signals from Ichimoku, it's too late. You like fib as Italian? Well, no, No, it's not because, Fibs were identified by Leonardo Pisano, but it's because they work. And actually, as you could see, only two of the Fib levels are really used. All the rest is just observation of price behavior grounded in price. It's price behavior grounded in actual price behavior. So that's the reason why I trade that. The Fib stalking technique also to test procedurally support and resistance is very powerful. So have a look at it. Use that as the potential to remove a lot of stress from trading as well. Can we apply it on lower TF? The lower time frame? Yes, we can. Yes, you can apply down to 1 minute and even tick chart, and you will see the same sequence. And this gives you also an opportunity, because if you are a day trader and you like to work on the smaller time frame, let's say the 15 minutes, the hourly, the 5 minutes, you can use the 1 minute for timing, which gives you exceptional reward to risk with these methods. Do you study order flow? Where orders are clustered and where there are option barriers, or do you only focus on Fibs? I only focus on Fibs because I think there's a lot of information there. Actually, if I'm able to model program trading, which is believed to have 20 to 30% of the volume, I think I can capture quite an important part of potential market behavior. Another reason why you see very simple charts is that I don't like to mix signals, because the more signals you have, even those from options levels and order flow, the more you have to reconcile. And I'm not very good at reconciling things. So you will be confused. Sometimes you will have opposite signals, and you will not know what you do. It's better to have a simple method which is highly reliable. I do not follow fundamentals, and that's a very good question, actually. And the reason for that is that it's my belief, and after years, I've a proof of that. Actually, program trading is in control of the market when there are no news and there is no central bank intervention. When we talk about forex, so. So I know that if I follow program trading, I'll be aligned to fundamentals. I know that I cannot trust program trading during news. In fact, I don't trade during news, and also program trading is inactive during news. Program trading is also inactive in the Monday morning and Friday afternoon. So the point to me is, I want to follow program trading because it's 90% of the time when there is no intervention in the market, and program trading will do whatever it takes to bring price into their targets. And that's the reason why I don't follow fundamentals. I hope this that presentation I believe is being recorded. I didn't record it, unfortunately, but I might record it and make it available on the blog, but more probably I will make it available to my newsletter subscribers. So if you want to subscribe to the newsletter, you can find the link in this slide. Do you draw in support resistance apart from drawing in Fib or the Fibonacci or minus 100% of support resistance? I do not draw support resistance in the traditional way, looking at previous highs and lows. I believe there is a flaw in that way of looking at support and resistance, because it's a way we explain price through simple models, the way we look at it, our eyeballs. But the market does not move like that. The market, I believe, moves based on the traces of that we saw, and those traces also include the psychology of the average traders taken as a group. So you will find sometimes that those areas of support and resistance correspond to the actual highs and lows support and resistance. but sometimes they don't, and you don't understand why the market is not stopping there. Well, actually, the market is not stopping that because it's getting to that area of support of resistance. How do you handle account data release and news? You'd be surprised. I don't trade news. And actually, I think you should not do either. There is no advantage there in doing that. You only get volatility, but that volatility can go for you, it can go against you. And actually, there is no need to trade during the news to make a living in the markets. And actually, I discourage that actually. And if you go to my website, fibstalker.com, you will also find a free ebook. You can download it. And one of the areas, the free book is called Key Concepts to Correct Trading Behavior. And I discuss why, in my opinion, because that's my opinion, and there are people who are very proficient in trading news. But I'm not, and to be honest, there is no reason to do that. It's more of a gambling, and during that period of time, program trading is not active. You're very welcome. What do you think of Elliott Wave? Elliott Wave, it's one of those trading concepts I call there is an order in the universe. I think it's not grounded in actual market participation. The reason why Elliott waves can be successful is due to strong money management, risk management, strong psychology. That said, now, I mean, I really have an appreciation for people who can make it work. I cannot, but it doesn't mean that it's not a viable method. I know people who actually can make it work, but I believe that the strength is more in the money and risk management. I'm an expert on money management. I've wrote my master thesis on money management, and actually I contribute to research as well. I also wrote a few research papers for the IFTA journal. So, I know risk and money management very well, and I believe that that's the reason for the success of waves. What hours are you typically trading between? I can take positions also in the evening. I'm mainly a swing trader. But the hours I look at and participate at, the most important ones for Forex are definitely the European Open, 8 to 10 GMT, and the US Open. Those are the hours where program trading will commit, and very often you'll see a reversal. You'll see price approaching those areas of support of resistance that I showed you before, right at those times. You're very welcome, Andros. So I think thank you very much for your questions. They were very useful. If you want to discover more, thank you, Danny. If you want to actually discover more, please go to my website, www.fibstalker.com, and do whatever you can to get my free newsletter. Actually, it's very simple to do that. Just go there and subscribe. I actually I have a respect for your privacy. Actually, hate spammers as much as you do, and I will only use that email for the newsletter. If you want, you are in control. If you want to unsubscribe, do it anytime. And in the future, maybe in the next few weeks, I'll start with some mentoring program. And if you get on my newsletter, I mean, you might get some interesting discounts. Okay, so very good. What can I say? So thank you very much. Thank you. I know that this webinar has been recorded, so you can watch it in archives. I'm very glad it has been recorded as well. Thank you very much for your participation. Thanks to FX Suite who gave me the opportunity to participate and offer you this content. Thanks a lot. Bye-bye now.